Tomas, we are back, my friend, and you know what that means. Time for a little bit more Tasty Live with this man. Chris is in the house, and let me explain. What's up, Chris?
Gentlemen, I am so happy to see both of you.
It's good to see you, too.
It doesn't look like a face that's...
You don't, does he not look happy? He looks happy.
Does he look happy?
For him, he looks happy.
For him, he looks happy.
him, he looks
okay,
happy.
I don't know.
For him, he
That's
looks
kind of that's a little CompuSalt.
For him,
Yeah,
he looks
That's
happy.
fair.
Yeah.
I'm a little salty this morning because the rigged Tasty Live Fantasy Football League has officially seen my elimination from the playoff picture. I know that Josh and Jamal and Ryan all agree with me as well. We really got to bring some folks in to audit the situation.
Oh, so it was rigged again this year. Who won? Nicky Batten and John? They win every year.
It's not over yet, but it looks like actually Paul and Nick are going to be the ones who come on top. But you Chicago guys are always up to something.
Nick comes from winning stock. I mean, it's just how it is.
He comes from big stock, not winning stock.
He's a
That's
winner.
fair.
He's a winner.
You don't want to hear me kvetch about fantasy football, though, so let's explain perhaps some things, because there's been a lot of interesting price action over the last
There's a lot
week.
of things in this world that I've listened to people bitch about, bad trades for 40 years, and I've listened to people bitch about lots of things. I cannot listen. If somebody wants to tell me about they played the wrong fantasy player or they bitch about fantasy football, it's the only time where I just want to be like, we're done.
You've had enough.
I've had enough. Yes.
None of that going on here. Just calling for a recount. That's all.
Good, good.
A lot of interesting price action over the last week. Obviously, gold prices took everyone's attention at the start of trading on Sunday night. Too bad you guys weren't on first call, because that was a wild first 30 minutes in the market, seeing gold prices go up by 3% or so. But I want to rewind the clock to where we were last Tuesday, on the last time we met here on Let Me Explain, because we were talking about the oil market. And on Tuesday, Wednesday, and heading into Thursday, oil prices were actually perking up, well in line with expectations. And then, of course, we had the ever so disappointing OPEC Plus meeting. Why was it considered such a disappointment? Why did oil reverse to the downside? Well, ahead of the meeting, expectations were beginning to build up that we would see a substantial production cut. There's a difference between production cuts and quota cuts. Production cut is, if I produce 1 million barrels per day, I'm going to stop producing 1 million barrels per day. I'm going to bring it down to 500,000. A quota cut is, I have the ability to produce 5 million barrels per day, and I'm going to lower my quota down to, say, 4. Saudi Arabia was expected to announce a 1 million barrel per day cut through the end of next year. Instead, they only announced a voluntary cut through the end of the first quarter. And the changes that we see are not necessarily actual significant production cuts outside of the expectations, but just changes in quota. So again, if I say that I can produce 5 million barrels per day, and in actuality, I'm only producing 1, and then I lower my quota to produce up to 4 million barrels per day, that's a production cut on paper. It's not one in reality. And so you see oil markets get absolutely slammed by this decision. We dropped from around $77 a barrel to where we are now, just hovering north around, I see like 72 here, depending upon what futures contract you're looking at. And this is a market that now has been completely upended. Volatility is still here, folks. I mean, it is a place that if you were looking for vol in the market, this is the place you should look. It's just going to require a little bit more patience if you're trying to operate on the long side. If you're looking to sell puts, do a put spread, for example, there could be a little bit more of a washout. Technically, the chart looks, to speak in a technical term, absolutely terrible right now, and it does appear that more losses could be likely. I would be keeping an eye on what happens when we get around to that $68 to $70 area, which has been a zone of congestion if you look back to the summer months before ultimately we did spring to the upside. The volatility situation is still very appealing, and the positioning situation is still very appealing. The net longs in the market over the past week have dropped further, and I would imagine now on the other side of this OPEC meeting, they'll have trimmed by even more. So the setup is still there. A little bit more patience is necessary, but OPEC Plus, they disappointed us last week. They let us down relative to our expectations, and oil, it's been having its time, dare I say, in the barrel the last few days.
I find it interesting that is something that you find interesting. Like I'm more amused by the fact that you find that interesting, because like,
well, the segment is let me explain, not what does Chris find interesting, because I don't find it interesting at all that OPEC disappointed us. They're a cartel in name only, right?
No, I know, but I find it interesting that you're trying to explain the drop in, in crude oil prices when I kind of feel like, I can't think, if I was to say what market is the most manipulated marketplace, the only market I would really argue that's manipulated is probably crude oil. I can't think of another. I'd be hard pressed to think of another market that's more manipulated than crude oil. And I think crude oil, most of the crude oil manipulation stems from years back when the Saudis actually thought they could push around oil prices and manipulate markets with statements and and just all the different things. They have this they kind of have this playbook that they follow. And they've been using this playbook since the 70s. And the playbook doesn't work anymore. Like, that's the problem. The playbook worked for, a couple of decades because, dumb traders and everybody else, they just bought into it. And so the playbook worked. The playbook doesn't work anymore because the marketplace has gotten too big. It's too damn efficient. These companies are too big. There's too much money. And so all of the stories and all the manipulation and everything that really is, I just don't think it's, I just don't think it means anything. I just don't. I don't think that's, I think oil was grossly overpriced. I still think it's overpriced. I think, next year we might see oil back in the 50 handle. And, and the reality of this year is, except for a couple little blips to the upside in the mid 90s, we're kind of, pretty much flat, right? Yeah. I think it's a pretty good trading year for oil. One other thing I want to mention, I was on an airplane on Sunday night, so I missed that opening, but I think that was a fat finger mistake on gold. I think it was a fat finger. I think I don't buy the whole whatever happened. I just think it was a fat finger. It cost somebody a crap load of money, but I think it was a fat finger.
A fat finger, perhaps, but also we were moving up through the all-time highs. So I think it was accelerated by the fact that a lot of stops were getting eaten in the market. And it lasted all of 30 minutes, right? But by the time we got off of first call, we're up at 2150 or so, and then it was a straight line down thereafter. And yesterday, you see a 5% swing. According to Anton, he was bringing the stat up yesterday. If you go back over the past 30 years, it was the 8th largest trading range that you've seen in gold. So yesterday was a historic day for the gold market. But it seems like a confluence of factors there, right? Someone executes a big order, perhaps too big of an order, right at the market during an illiquid time. And liquidity is coming in. It's not all full and present right at 6 p.m. Eastern on a Sunday. And then you see the stops are eaten out, so that accelerates it to the upside. And then we also saw yesterday a retrenchment in those Fed cut odds. There was a point on Friday where the market was pricing in 150 basis points worth of rate cuts from the Fed next year. Not one in January, but starting in March. There are 8 Fed meetings a year, which means that 6 of the 7 Fed meetings starting in March for the remainder of 2024 are going to produce a rate cut. In what world is the Fed cutting rates that quickly unless something is going horribly wrong in the economy? Plain and simple. And so as those rate cut odds normalize a little bit, yesterday went back down to about 53% for the month of March. Energy, it's coming off. We're seeing that oil prices obviously doing what they're doing in a separate world. But you're looking at treasury yields. Those are moving higher. Stocks are coming off. There's kind of a rebalancing, a sobering up moment. Like, do we really think that we're going to get this much Fed easing next year? If this is a soft landing, probably not. And so it was a nice confluence of factors to bring gold back down. But yeah, I saw one rumor. It was the PBOC. It was the PBOC and the Swiss National Bank that were doing this, which is why if you look to Basel yesterday, their head of gold on the Bloomberg terminal, their head of gold trading was online until like 10 o'clock at night local time, trying to manipulate the market. So always a fun day when you get those kind of rumors floating around from the ever knowledgeable Twitterati out there, Chris, trying to find some reason.
I'm going to fat finger and I'm not changing.
I know you, and you said that very early on. Chris,
said it yesterday.
I think it's really interesting because you mentioned it as soon as you came on, like, it was after hours. You know what I mean? Markets aren't that tight. We just mentioned liquidity a moment ago.
Especially gold.
It always seems
Sunday
to happen,
night.
and the fat finger always seems to
That was
happen
total fat
overnight.
finger.
I don't know, man.
I've watched this.
I know, I've watched it too.
I've watched it for 40 years.
First it was the grandmother in Ohio with
Fat
the
finger.
S&Ps with the fat finger, and
somebody
now
was
it's
trying
the
to do
oil
a
with
one
the
lot,
fat
and they
finger.
did a
I don't
1,000
know,
lot
man.
instead. It's all it is.
At highs, I don't know.
I mean, it just, and it was somebody it wasn't a retail customer, because you see on the retail side, you're protected. Because on the overnight session, you're going to require, there's no intraday margin. So on the retail side, it's going to require a crap load of money. But on the institutional side, on the member side, there's no, you can do whatever you want.
Yep.
And so somebody was trying to do a 1 lot or a 10 lot and did 1,000 lot or something like that. And it just, and then everybody thought there's something going on somewhere in the world, and, blah, blah, blah. This country's bombing that country, or this central banker saying this, or some gold trader, whatever. It's all horseshit. It will come out. It will, and they won't admit it, because it'll be some big firm like UBS or somebody like that just fat fingered it. But on Globex, you don't put 1,000 lot market order to open on the Sunday night opening. It just doesn't happen unless it's a fat finger. Period. So all this speculation and whatever else, the first thing I said to Tony as soon as I saw it Sunday night, I'm like, fat finger, 100%, nothing else. They could have all this talk and speculation and whatever else. It's just a fat finger mistake. And someday somebody will cop to it, but until then, we'll see. Let's see what else. So we're entering that period, Chris, where we, just based on this conversation, we're obviously looking for stories. We're looking for, we're looking to make a case. We're looking for, stuff to talk about in the next couple of weeks. We have a week and a half left to DC expiration. Then we enter into what we call a quiet period, which is just kind of, 2 weeks of dead holiday trading until we get to, New Year's. But we still have, 7-8 days left going into, 9 trading days, including today, going into the, before we get to DC expiration. No earnings left. I mean, what's the market going to gauge itself on? Apple's saving the market today, but are we missing something? Is there something else? Like what are people, everybody's gonna go, well, so obvious we're gonna rally. It's not that obvious we're gonna rally.
I agree.
At all. And December, as much as I'd like to think that December tends to have this December tends to be this very strong month. We've had some very ugly down moves in December. So, I'm not sure. What do you think? What moves the market? Where are the drivers coming from?
December's actually not a great month for stocks. Over the past decade, the S&P's lost 0.21%, Nasdaq's lost 0.71%. If you like bonds, this is a good month for bonds for both ZN and ZB. It's a good month for gold. It's a good month to see volatility, quite frankly, expand depending upon where you sit. And I think that's something that we would all enjoy if volatility ticked up a little bit more. But we're making our way through to the meat of the macro calendar. It's very condensed this month. Today, at the top of the hour, actually in about a minute, we're going to get the JOLTS report, the job openings report. Tomorrow we'll have ADP. Thursday we'll have the weekly jobless claims figures. Friday, of course, the main course for all of this jobs information, the non-farm payrolls report. Expectations are fairly modest, looking at around 175 to 185K at the headline. Although, some of the things I'm seeing on the margins right now in the jobs data aren't really that reassuring. I've been repeating this a lot in other venues here on Tasty Live. Continuing claims are up 24% year over year. In the entirety of the data series, we've never seen a 24% increase in continuing claims outside of a recession in U.S. history. Period. End of story. That's not something that people should be taking lightly. It's not something that just happens, and maybe it's a coin flip if it means something this time. I also see that federal tax receipts are down year over year. Has the tax code changed? No. So that means there's less economic activity in the economy right now. Every single time, but for once, 1964, when you see a decline in federal tax receipts year over year, what's happened? A recession. So it looks like the economy is slowing down. In fact, the Atlanta Fed GDP Now growth tracker, which pegged growth for the third quarter at 5.4%, when in reality it was 5.2, now is forecasting a 1.2% growth rate here, based on the data received thus far. So the economy is clearly slowing down, plain and simple. It's just in the numbers. So you get the jobs report on Friday. I think it could come in a little bit weaker. You have CPI next Tuesday. You have the Fed meeting next Wednesday. And then that's kind of the month, triple witching the week after, and then it's time for the holiday. So if the market's going to move, if you're looking for binary event risk outside of earnings, the next few days will bring it to you. CPI could see a little bit of a lift, although energy prices have come down a lot, so maybe a 3.1%, 3% reading. It really falls off hard at the start of next year when the data series rolls over and the base effects disappear. And I can't help but think next Wednesday with the Fed meeting, people should be keeping an eye on it. I know we're not expected to see a move. Fed Chair Powell did soften his tone on Friday for the first time. He said that rates were sufficiently restrictive, which is to say that we've moved far enough into the hiking territory that they could start thinking about what it looks like on the other side. And it's worth reminding everyone, if we do get a cut in March, that's historically right on the nose. The average time between the end of a hike cycle and the start of a cut cycle is exactly 8 months. What's 8 months after July, the last Fed rate hike? March 2024. So this would be fairly normal right now. 70 points priced in through the end of next week in the S&P 500. So not a lot, but still, maybe a little bit more trouble in the days ahead if some of these job reports, if the inflation data of the Fed meeting goes sideways. The bar is really, really low, which in turn means it's easy to get one little piece that upsets the apple cart.
Well, while you were talking, I'm not exactly sure what just came out at 9 o'clock. But
the JOLTS report.
He just said it. Even the S&Ps are down 3, NASDAQ up 27.
NASDAQ's up 26, and the bonds are up 121. They just broke 119.
119.08. They didn't just break it. They crashed right through it.
Like a
hot knife through butter to the upside.
Yeah.
Job openings decreased to 8.7 million in October. So, we were at a point earlier, you could say middle of last year, where there were over 2 job openings per every single person unemployed in the economy. That's now normalizing. It's getting closer to like 1.5 right now. And so the fact that you're seeing these two things happen, job openings are declining and continuing claims are rising. People used to be able to fall out of their job and immediately before they hit the ground, they'd have a new offer in their hand. Now, as people are leaving their employment situations, they're having to stay in the unemployment line for longer than they were previously. Both of these things showing that the labor market's normalizing, but both of these things are also things that happen when an economy is creeping towards recession, which I know everyone is on board with a soft landing now. That's a place where I was all year long. Don't worry about growth. Time to take the other side of that trade. The economy is absolutely slowing down. We're probably going to see a more concerted slowdown this quarter, next quarter, maybe even to the second quarter of 2024.
Nice little reversal in that Russell NASDAQ trade from yesterday. I think Apple saved the
Apple saved the apple cart.
Apple saved the NASDAQ bulls. No question about it.
It's only moved a couple of thousand. Not time to put it back on.
Yeah, no, not yet. No, not yet for sure. I'm just looking at just the markets here, Chris. While you were talking, there's just been some pretty extraordinary moves in a very short period of time.
We blame you, Chris.
Well, I don't know if it's.
You're welcome.
Is it really a blame? I don't think
it's your fault. I don't know if it's blame or not. I give you the credit. It's your credit. It's your credit.
Could be credit. Yeah.
It's your credit. To your credit.
Yeah. No, I don't think it's a bad thing. I think it's interesting. I thought the market was a little oversold yesterday, and it was kind of like weird opening down so much today. All right, Chris. Very interesting stuff today. Any parting words you want to throw out there?
Good night and good luck. Next few days should be fun with all this jobs data coming out.
I think the next few days will be fun. S&P's up 250 now. They just had a, pretty solid 20 handle rally. But that's it. All right, man.
Beautiful.
Thank you so
my
much.
friend. We're going to take a quick 90-second break and come back. We got a market measure next. Thanks, Chris.